In today's video, I'm going to show you exactly how to finally become a profitable trader and start earning your first $10,000 per month. How? Well, we're going to identify where are the big institutions going to push price next. And in order to do that, we need to understand market structure. The biggest problem I see traders out there is reading market structure wrong. But in today's video, I'll show you exactly how to do this correctly so you can dramatically increase the probability of you winning more consistently. Hey guys, before we get started, I just wanted to offer you access to my exclusive Wolfpack Discord group that's now based on WAP. Basically what you're gonna get in here is something I call the Quantum Cipher Report. This allows you to steal and copy all of my trades and learn my exact trading system. Every Monday, I'm gonna give you the best crypto altcoin picks that are getting ready for explosive moves. I'm also going to give you the best trade setups in Forex, futures, and CFDs as well. You have to be a multi-asset trader if you truly want to take advantage of the entire trading environment as a whole. Not only that, you're going to get access to the Discord, all of my courses, over 30 hours of recorded educational content, in addition to my Trading View degenerate indicators. Okay, so if you want access to my WAP, there's going to be a link below. Join the Wolfpack and get all of the best trading picks in crypto, Forex, and futures sent to you every Monday. On top of that, 30 hours of educational content so you can learn my entire system, all for one low monthly price. I'll see you there. All right, guys, welcome back to the channel. This is going to be part one of a little mini series on market structure. Today is going to be kind of the beginner principles of understanding this. So definitely hit subscribe and turn on the notifications bell so you get the next series when it actually comes out. So what are we actually doing here? Well, we're going to identify the footprints of the largest institutions in the world. Why? Well, because they are the ones who influence price the most, and they are generally taking control of the trend. And the trend has always been your friend. And where traders mostly get this wrong is they start trading kind of in random areas or trade against the trend. If you really want to increase the probability of you winning more, you must understand where are institutions pushing price. Are they in favor of bullish behavior or are they in favor of bearish behavior? And market structure, while it's not perfect, gives you a much better framework for understanding are institutions bullish or bearish. And that allows you to create a bias of should you be buying or selling when it comes to your actual trades. So let's just get into kind of how we understand this actual logic and framework. First of all, this is the glossary. Take a screenshot of that. That's basically what we're going to be talking about and discussing today. But when we first begin our analysis, we need to identify essentially a swing high and a swing low. And once we're in that swing high and swing low, this is essentially a range. And while it's in there, it doesn't really matter. We don't have any bias about what we think institutions could be doing next. What we want to see is a break of structure either to the upside or the downside, and then we can create a directional bias and then start setting up trade plans to then follow along in their footsteps. So let's just take a look at some bullish market structure here as an example. Say this was the beginning point of our analysis. Like this price action over here doesn't necessarily exist yet, but we want to pick a swing high and a swing low. And essentially, if price remains in this range, we don't care. It doesn't matter. We don't want to trade within this range. What we want to wait for is potentially the actual swing high to be broken. And if the swing high is broken, this is now known as a break of structure because now the actual range of the high and low has broken to the upside. So that would be a bullish break of structure. And now we can create essentially a bullish framework and bullish bias on this. Now, what we want to do here in the buy theory in a bullish structure is to buy pullbacks or corrections into demand zones. So typically what you would see is essentially probably a pullback into some sort of demand zone. If you don't understand demand yet, I do have another video that I explain fully demand. I'll link that below also. But essentially, we want to be buying the correction into the demand. We don't want to be buying this breakout or impulse to the upside, the break of structure. This is where most traders get it wrong, is they see momentum and they start FOMO buying into momentum. And then on the correction, they get stopped out because they bought at the top. Where pros and institutions are buying into the correction and waiting patiently for the market to come to them. We never want to be chasing the impulse. We want to be patiently waiting for the correction into a demand zone, and then we ride the impulse for the next break of structure. And so then once you do have a break of structure such as this, then we can finally start drawing a new range. So once we have the break of structure, we now know that the new range is essentially this low here and the actual new swing high. Okay, so now we have a new swing high, and basically the pullback between the previous swing high and the break of structure, the lowest point of the correction is now the new swing low. So in order for price to remain bullish, it must remain above the swing low. Okay, and in order for us to be bullish continually on this, one, we're going to want to wait for, if we're going to try to set up a trade here, we want to look for an area demand possibly near the low here and buy into that dip or correction down here. And then we want to ride the next impulse as this potentially breaks over the other swing high, which then turns into a break of structure. So this is just kind of on repeat as we actually go through this process. And then once we actually have a new swing high, if we create a new swing high up here, then this correction low becomes the new low. And then we have the new swing high points here and here. Now, you might be wondering, how do we know when the swing high is actually there? We don't know when that top is actually in. So there's a little bit of a rule book that we can create for this, okay? So when you actually have a bullish market structure such as this, how do you identify when this is actually the top and you should start be looking for the correction? Or is it just gonna keep pumping and then you actually might buy the wrong correction, okay? So there's an easy rule to actually see this in principle. It's called the 3 candle succession rule. And essentially what you wanna see for it to be a real swing high for another pullback in order to actually be able to draw the swing high for the potential break of structure is the 3 candle pullback. So what you would want to see is one, okay, the pullback of the highest point of this actual break of structure, swing low 1, right? The low of the candle, that's 1. Then we have swing low 2 here of the candle. And now what you want to see is a closing candle below that actual second low of the candle. If it does close that below that, we now know that this is going to be a pullback here. And now we can essentially say this is like this, okay? Now we know that this is the swing high, and now we can draw that as a swing high and know that if price does come back up to that point and breaks it, this is actually going to be the break of structure. This is where a lot of people get mixed up and kind of confused. We'll go into the charts and kind of explain this a little bit more, and that finally turns a break of structure. So here's an example of where people might get screwed up on this. Say we're looking at this chart right here, and some people might be confused, like ignore all this over here where they're like, okay, well, here's a swing high, price is pulling back a little bit. Now, this is going to be the break of structure, where they might confuse that as, and then they draw this as the low, swing low, because the structure broke, and they might get confused that price is shifting into bearish territory when actually this is just the pullback and correction. Okay, so what the people would get confused by is, let's say here's the low of the first candle, here's the low of the second candle that needs to be broken. Now you might be confused by this, be like, it broke, so that was the swing high, but it has to be a closing candle below that low. So right now, all this is just a continuation of one big move to then this actually becomes the swing high. So we should have some examples to show you that later on the charts, but we want to make sure in order to call it a swing high that then can create a break of structure is we need that 3 candle pullback in the correction phase to actually call it a swing high. Now let's look at some bearish market structure. Just for an example, we have the swing high, swing low. Once this low is actually taken out, that would be called a bearish structure. Now in this situation, if there was a 3 candle pullback on this actual correction to the upside, we would say, okay, this is the new swing low. And now this still remains the swing high. So as long as price remains below this swing high, we're still going to be bearish. And then we're going to be looking for on that dip there, some sort of area of supply to sell into. And that is what we want to do. We want to sell into that supply and then ride the impulse down where eventually this turns into a break of structure. And now that broke the structure, we know that this is now the new swing high of this actual. So as long as price remains below this actual swing high, we can remain bearish. And then again, we have another break of structure here. Now the low of the actual pullback remains at the new low for the swing high, right? And it just continues on down and down. And again, what we're trying to do is short into areas of supply after the break of structure. We don't trade into the momentum. We wait for the momentum to be broken and break of structure. And then we want to trade that correction and then ride the next impulse down. So how do you identify when this is coming to an end? Well, it's either a market structure shift or a change of character. First, change of character happens. Then there's a secondary confirmation of a market structure shift. Some people like to just trade the change of character, but a lot of times that change of character might be a false signal, and then it's just a shakeout before the actual trend continues. So let's take a look at examples of what this might actually look like. For one, we have the swing high, swing low. We have the break of structure. So now we know that this is the swing low here. Price broke out. We had a 3 candle pullback, creating the actual pullback confirmation. So that turned into a break of structure. This new low now becomes the new swing low, right? Break of structure again. Now that after this break of structure again, this becomes the new swing low, of which we can draw this here, swing low. Initially, price comes back up, looking like, so this is where you might take a trade and it might turn into a trade you get stopped out of, okay? We were thinking, okay, it broke structure, has a swing high. I'll buy into demand down here for the dip, and you're expecting price to just shred through and break that actual high and get the BOS to the upside. But that doesn't happen, okay? What happens instead is price breaks through demand, crashes through this swing low, and that creates a change of character because now we're not creating higher lows anymore. And now we actually broke down the swing low of the market structure. And that is the first initial sign of a bullish to a bearish market structure shift. Now you can trade this again. Once you see that that change of character, is look for an area of supply to then potentially short into. As long as price remains below the swing high, you can short into daily supply or weekly supply or 1 hour supply or whatever you're looking at for the next leg down. And as soon as you actually get that new low here, all right, so this would be the swing low after the change of character low. If you do break the change of character low, that turns into a market structure shift confirmation. And now we are officially bearish. Change of character is step one for the actual market structure shift from bearish to bullish or bullish to bearish. And then as soon as that change of character low gets taken out or high gets taken out, if we were looking at a bullish to bearish or a bearish to bullish market shift, that is the official confirmation. And then again, we're just on repeat here, looking for an area of supply to then short into for the market shift down to the downside. So this is the same exact thing that's happening on the actual bullish market structure shift, bearish to bullish. We have the swing low gets taken out. That is the break of structure to the downside. Now this is the new swing high because that structure has broken. Again, break of structure to the downside. Again here, then we have a new swing high here, break of structure to the downside. Again, market's still bearish. Okay, we can continue to short here, but then what happens here? We have a break of structure or a new swing low here, new swing low, but then this swing high gets taken out. So what does that mean? That means we have a change of character, which means we probably got stopped out if we're continually trying to short on that trade. And then we want to look for a demand zone to then buy into. And then on the correction of the change of character, ride the next impulse to the upside. Now, again, that is first step of the actual market structure shift. And then this would be the secondary confirmation of like, okay, we are officially looking like we are actually having a market structure shift. Then again, we want to buy into some area of demand here on the actual correction and then ride the actual impulse to the upside. So again, all we're wanting to do here is look for what we think the institutions are doing next. And by understanding this framework of market structure, this really helps us create a bias for being bullish or bearish. That's all market structure is identifying what is the current trend. What is the current trend in influence of institutional order flow so that we can try to trade alongside them rather than against them, because it's so easy to be looking at all this stuff and be on the wrong side of the trend. So once you start understanding this and actually implement it correctly and wait for corrections, buy the demand or sell the supply into the correction and then ride the impulse, that is where you can really start making some big money and increasing your risk to reward ratios as well as increasing your win probability. All right, guys, so let's just take a look at a weekly example of GBP USD. Now this is a bit longer term chart, but you can take this on any time frame that you want to look at to identify what is the long-term or short-term trend, whether you want to look at a daily chart, 1 hour chart, 5-minute chart. I'm a swing trader, so I like looking for long-term trends to capitalize on big moves going forward. So let's just take a look at actually GBP USD going forward here from the actual current price action that's been going on. Well, we have a swing low and a swing high. So we can assume that price, if it remains in these 2 points, isn't really either bullish or bearish. We don't really necessarily have a directional bias, but we can see as soon as price actually made that swing high, we have the low of that first initial candle, and we have the low of the second candle, and we can see price closing below the low of that second candle. So now we consider that a pullback for the swing high, and then price actually broke out above this level. So we could consider that a break of structure to the upside. Okay, so now what we want to do is wait for the correction into an area of demand to potentially be buying the dip. Now we have this area of demand down here, price dipped into demand and then on that correction and then had a big impulse move to the upside. And now that we have that actual break of structure and we know that this is now a new swing high because we have low of this candle, low of this candle, and we can see actually that third candle, we know that this is the new swing high. So we now have this is going to be the new swing high for a potential break of structure structure. And it, of course, does have that break of structure. And now that we have this new high and break of structure, the new swing low becomes the lowest point between the previous swing high and the break of structure. So now we have this level here, swing low, and the range in between there is basically this range here. Now that we have that break of structure, what do we want to do? We want to look for areas of potential demand to be buying into the correction. So we have this area of demand here, right? Dipped right into that zone and then shredded through that. There was also areas of demand that you could have had of secondary levels to be buying into if you did get stopped out there, right? So there's going to be multiple areas of potential demand once price has that correction into it. This one just retraced right into that actual first area of demand. And this is also right here going to be the swing high. Why do we know that's the swing high here? Because we had the first candle low, second candle low, and then a close below the second candle low. So now we know that this is the swing high, which then of course turned into a break of structure as we see here. Now between the previous swing high and the break of structure, the low midpoint, the lowest point of that is the new swing low. So now we know price is going to remain bullish as long as we don't break that low. Okay. And we're going to be looking for areas of demand to be buying the dip. I'm currently waiting right now patiently for a dip buy in this demand zone. Is it ever going to get there? We don't know. But if it gets into that demand zone, this is still definitely a very bullish area to be buying on the correction for the next potential leg up for this swing high, because this is now the swing high. We have this low here, one low, second candle low, and then this candle here broke below that. So we know that this is a swing high. So we can expect right now that institutions are still bullish and looking for buys in this demand zone right down here. And as long as price remains above this swing low here, we can remain bullish and look for dip buys into demand for the next impulse to the upside. But if price actually breaks down below this level, right, then we're going to be looking for shorting opportunities, because this is going to be a change of character here. And then we have areas of potential supply here, right? We have these indecision candles where we would maybe potentially want to be shorting here for the actual next leg down because price has shifted. And all we want to do here, guys, is try to identify where institutions are going to push price next. Are they bullish or bearish? If we can identify that by understanding market structure, that way we can start trading in the right direction and dramatically increase our win rate, profitability, and risk reward for our trades, because we're getting in at the right areas. Right? Buy in here, stop loss up here, TP up here. That'll dramatically increase your risk reward and win rate. Anyways, guys, that's a wrap for today. Definitely turn on the notifications because we got other parts of this. This is just the very beginning framework for understanding market structure. There's plenty more to come and more advanced ways of looking at this.